Alrighty. Thanks for joining the Nest Edge. We named this because we have a unique way of looking at data and gives us an edge over the choppiness of the markets and news cycles. So that's what this webinar is about. As with every one of our webinars, it's not advice, and it's important for us to make this distinction. This is an educational webinar. Use this as education for more informed decisions, and again, also to see how we do things. And again, this is not how everything is done. Obviously, in this game of investing, there are many ways to lose, and there are many, many ways to win. We are discussing our processes. For those of you that have listened to our webinars before and would like to move forward in building your portfolio with us, please reach out to us at info@nestfinancial.net. info@nestfinancial.net. Be happy to walk you through the process. I also read recently where every one of us knows 152 people on average. So that's an important number. If anyone in your circle, someone in your circle needs to grow their knowledge in financial arena, please let them know about our webinars and send them our links. We'd be happy to have them on as well. This is how we introduce ourselves to new clients, through our works and our conversations. This is a conversation between our portfolio manager, Sean McDougle, and myself, and inclusive of our audience. So if you have any questions, please make sure you add questions to the Q&A on the side, and we'll be happy to address them. Sean, thanks for being here.
Happy to be here.
Wow, it's been an incredible month. It's a heck of a month in many, many ways. I'd like to start off talking about the stability of the markets after we saw in the last few weeks. In your newsletter, we talked about the recent surges in GameStop and AMC. Let's talk about what happened for those in the audience that weren't clear on this. First, I want to just talk about short selling, because this is all around short selling. Can you give us a definition of short selling, how it works, and why it's done?
There's a few ways to do it. What it is you're placing a bet, if you will, that the stock is going to go down instead of up. I mean, that's the short answer. There are multiple ways to do it, but that's the real easy thing. And that's what kind of happened.
So in short selling, a lot of times, just to provide more meat around that, people don't actually own the stock. They're actually betting against the stock, and that they're betting that if the price goes down, they can buy it in the future at a lower price and make that difference. So that's something that many people didn't know was actually done in Wall Street, but it has been done for many, many, many years. And it's just one of the tools that people can use in doing so. Of course, it carries its risks. So why is it done, Sean? I mean, I just talked a little bit
originally, yeah. So the original design and reasoning for shorts or futures markets or options markets was a hedging strategy. So corporate America has a very big, it's called GE, has a lot of input cost risk associated with steel. So what they would do is build in hedging 6 months down the road to kind of smooth out their costs. So if there was a massive spike or fall in any of their input costs, they would have a smoothing mechanism. So, car prices don't jump 20% overnight. So that's the original intent with shorts. Mm-hmm. Now, like many other things, Wall Street has taken a hold of this thing and taken it, mutated it times 1,000. So it's kind of become an entire other space on its own, which was never the intention of what trading options is. It's a derivative market, which fortunately a lot of people don't understand it and don't really get the risks, how you can get chopped up, especially if you're, you got any sort of leverage or margin going on, and get real ugly real fast.
I do want to state something just again on clarity here. When you buy a stock, you have exposed risk. Let's say you buy a stock at $10 a share. Your exposed risk is if that company goes belly up, and what you have at risk is your $10 that you put into this stock. It can go to zero, but it's a defined risk, just $10. That's all you've got. If you bought 100 shares, you've got $1,000 risk. That's the most that you can lose when you actually own the stock. How is that different than a short seller? If you don't have,
it depends on which side you're on. whether you are, again, this is, I'm trying to simply explain a complex situation. If you are the one that is, again, it depends on how.
Let me clarify that a little bit more.
Yeah.
If I go and say, okay, I want to short this stock that's right now at $10, where's my risk? Is up or down? Price goes up.
Yeah, the price goes up, it goes against you.
Mm-hmm.
Now, but there are ways, instead of doing the more traditional route, which what really happened was, with short squeezes, you're not really buying or covering the actual share, you're buying option contracts.
Mm-hmm.
And each one of those has a value, a numerical value that's constantly fluctuating. So there are times when you can go out and buy what's called puts,
Mm-hmm.
and your only exposure, your risk is what you bought those puts for. Now they also go to zero.
Right.
Now, if you're on the other side of that, if you are what's called writing puts, you're selling puts, as in your exposure is, to the moon.
Right.
Yeah, it's, so it depends on which side of option tradings you're on, and if you are doing it, how you're doing it, if that makes more sense, because it's not as clear cut as just buying or selling stock. There's layers to it.
Many ways to do this. I was at the most simplest of concept. If you sell something that you don't own and that stock goes to the moon, and you've got to go buy it back later, you've got much more than $10 exposure. It could be 20, it could be $100 per share. So there is some real risk to this. So let's talk about Wall Street bets and Robinhood. What happened here? Just I know we've talked about Robinhood in the past. We hadn't really talked about Wall Street bets. So
that's new. Yeah, I'd never even heard of it. I'd never even heard of these guys.
Yeah.
I stay away from any pretty much news source or that I have not, either it's been introduced to me or I have found invented. Reddit is not that. It's a bunch of do-it-yourselfers, which is totally fine. I appreciate it. They have all do whatever the hell they want. That's not the problem. But what their goal was, I still don't understand. Like, how the hell are you going to take down hedge funds by just, short squeezing? We still don't know who or what hedge fund actually went down. I'm assuming somebody did because of, the volatility and the volume that just appeared out of nowhere. Because Reddit users don't have the time, the money, or the experience to, last long enough, if that makes sense. And that's part of the reason why we've seen the price come all the way back down to earth. People are panic selling.
Right.
So it is a unique thing that I've never seen before, that you have Reddit band of, Reddit warriors coming together and say, all right, let's buy and hold. The problem is they didn't.
Right.
They didn't, or the price would have stayed where it was, which it got up into touched 400, which is insane. It's falling all the way back down. I think it's around 50 or 60 today. So, we'll see how this plays out. The sad thing is there's already stories starting to come out that, people have I couldn't, I need that money back. I can't sell because I need that money back. I can't afford to lose this.
Right.
And that's the sad thing, is people get sucked into these things. The people that the most vulnerable, the ones that have the most to lose, buy at 350 and then it goes down to 50. And,
that's the name of the game. It happens. So just for just adding again more to meat to the story, Reddit and this group of people band together and they pumped at each other as far as getting the prices to go up and to go against what other people on Wall Street were doing, the short sellers. And that did cause some big news and big waves, lots and lots of volume. And as you pointed out, if during that time these short sellers had to cover their shorts, they did lose, but they weren't losing their money. They were losing their clients' money. They're losing investor assets.
Yeah.
So that's what we see.
The sad unknown thing. Yeah, that's not being talked about now. I don't know what hedge fund got hammered on this. They could have just been losing, ultra wealthy money, which I don't care about that. But if they're losing teacher pension money, that's a sad you don't know, so we'll find out in 6 months. These things take time.
Right. Some of the things here, and you pointed to it, is to have a successful strategy, you've got, when you've got a bunch of people coming together and doing something, there's no controls. One person might say, that's enough price for me, I'm going to go ahead and sell out. But because you don't hold it all the way to the end, it's really hard to reinforce or keep that price at a certain level. But I want to talk about daily volume, because we have talked about this in our previous webinars. And as far as the changes, what we see, and in your newsletter, you put out the differences in what was traditional volume, meaning people trading on the market, non-professionals, and now what we're seeing. Can you touch on that a little bit?
Yeah, it's become important. I guess the mean way or rude, I don't know how to politically correctly say this, but we call it uninformed volume. That's kind of what we call the retail investor. They're generally speaking, retail investors make a lot of mistakes, and they get sucked into FOMO and headlines, and they'll read an article and just like, oh, this person sounds like they know what they're doing, I'll go buy it just because of this person. And they just there's opportunity for us in those situations, and in the longer term, just because we have a little more runway, and our research is generally way better than the average retail investor. And I'm not saying you can't go do this on your own. It's just where are you getting your information, and what is your risk management process. So we historically, retail volume 1 to 3% doesn't really matter.
Right.
Even if it did not really matter, and COVID changed that game. A lot of people are sitting at home, have time, and the ease of trading has gotten much easier and much cheaper. Until let's call it fall of 2019. It used to be every time you made a transaction, there was a cost associated with that. It used to be like $25 a trade, and it kept falling. Summer of 2019, I can't remember exactly when it was, sometime in 2019. All the big boys went to zero cost trading. So you can get on there and trade as much as you want there's no fee drag. So that changed it. The ease that you can get in and do things now. So again, this is according to a couple different sources, but on average, 20 to 30% of daily volume right now is the retail investor. And that is a massive difference of what is normal. So you get, let's just say, a third of the people out there right now are what the pros would call uninformed volume.
Right.
And that's where wild things start happening. It's, you have to be a little bit more aware, because the rules, it's like the rules matter, but they don't, and they're changing, and they're not changing. So you got all this
dynamics.
It's unique. You got to think about it. It doesn't change our process, but it's something you have to be aware of if things are like with GameStop. Like, we were long GameStop, but I sold out of it aggressively.
I want to get to that in a second. As far as GameStop, I just want to put a bow on what you just said, just for people to understand. If you're looking at a portfolio, let's just call this your own portfolio, 1 to 3% of any kind of asset isn't really going to hurt your portfolio. It's going to, you have 97% of other things that are more professionally managed. If you've got 1 or 3%, it's a small risk. But if you've got 30% of your portfolio in something that's highly volatile and just goes all over the place, it does make a huge impact on your portfolio. So if you take that context and say that's what's happening in Wall Street right now, where you've got 70% are, and I'm going to just call it more informed professionals that are looking at data and making purchases based on data. Even short sellers are making decisions based on data that they're seeing. And then you've got 30% that aren't doing that. Then it does cause a lot more volatility. Before we jump into what you were about to talk about, we do have a question from the audience. And the question is, are Nestfolio investments involved with short selling or taking a short position in the market? If so, why, and which funds take that position? Moderate? ?
No, moderate is long only, ETF only. So there are two models. Our two most aggressive one, Alpha and Aggressive Growth, did have GameStop. Aggressive Growth is totally out.
Well, they're asking about short positions.
Okay, I'm sorry.
Yes.
Yeah. Aggressive Growth and Alpha will do shorts. They're very risk managed, and then we're not, it's still a very small percentage of the overall model. We're just taking advantage of, like right now, we're short gold and treasuries. It's been awesome. Now, eventually we're going to change that and we're going to get long golden treasuries again at some point this year. It's probable. So it's never something that we're just sitting there holding it. There are more aggressive models when we see clear screaming, either green or red flashing lights. Yeah, with those models, we will absolutely go long and short. And with alpha, we'll use leverage as well.
For clarity, there are 6 portfolios that we manage. So Sean's talking about the 2 most aggressive. So 4 of the portfolios that we manage, we don't do any type of short purchasing or any kind of leveraging on those. And we've got every portfolio that we've got has a unique goal towards it. So we have our income portfolios that are strictly investing in things that are based on income, conservative, growing by a certain percentage. And then we have our moderate. Then we have a growth. All of those portfolios are all what Sean said, long. Long means that everything we purchase in there is owned. So there's no short in that at all. The top 2, the most aggressive ones for some of our clients that want to make more money, we have more leverage. Those do have some leverage there. So just to kind of wrap that up.
And still pretty small percentage wise. Like, I mean, I'm looking at alpha, which is our go time mode. I mean, it's 7% of it. 7% of it is shorts. Just it's pretty small, and that's across 4 different positions. So it's pretty spread out, and you know, they've been all excellent calls so far.
So I want to talk about processes, because there's a lot of news that came out based on this GameStop and hedging and whatnot, and really Wall Street bets. And there was even some hedge fund managers calling it not fair and this and that. We know it wasn't them that lost their money. It was their clients' money that was lost. What legislation do you see coming out of this, if any?
Probably nothing. You know,
There's nothing illegally done that we can tell. It's just, somebody
Nope.
saying, here's what we're buying.
Yeah. The only thing that got a little dicey was when, GameStop started governing and regulating how many shares they could buy or sell. That's a little slippery, but they had some valid reasons for it.
Mm-hmm.
So no, nothing, as of what I've seen, nothing illegal or shady was going on. Wall Street wasn't, manipulating things. And I laugh about Wall Street saying it's not fair, because what a joke. Yeah, no, as of right now, I have not seen or heard of anything that looks like there was some sort of fraud going on.
What we're seeing here is the influence of tech companies and what happens when a lot of people are, as Sean mentioned, are at home and have time on their hands, and they're playing with the market, and it's banded together by tech type company that can
Community of communication. Yeah. Which was, rewind 10, 20 years.
Wasn't
for
available.
Multiple reasons, it would have been impossible.
Right. So I do want to talk about our investments in GameStop or AMC, and I want to make a distinction. Did we invest in either GameStop and or AMC, and why did we do that, if we did?
We only went long GameStop, not AMC. There was fundamental reasons. It originally came up on our radar in December.
Okay, so this is way before Wall Street bets.
Oh yeah. Before all this mania happened, we added at the beginning of January, and their fundamental reasons were the price was so, and you don't just, whether it's expensive or cheap, but it had gotten hammered in 2020. Mm-hmm. And there is an activist investor, Cohen, Ryan Cohen, he started Chewy.com, sold it for $3.5 billion to PetSmart, I believe. And he was awarded basically 3 seats on the board of GameStop, and it's all his buddies they got Chewy up and running. Mm-hmm. So they're the fundamentals were positive. They're what's called, look at the pods, rate of change of their revenue, their growth, everything was trending, their comps were doing, everything set up well. And then you had this activist, Cohen, coming in and is getting board seats given to him. So there were some, and again, we only get a little more sexy and aggressive with our certain models for stuff like this, because there's obviously risk. Mm-hmm. So we were in it beginning of January.
How did we
do?
And
then the storm of mania of, my phones just started getting alerts. Anything that we are have any position in. Like if anything news, my phone will just start pinging if something or articles.
Mhm.
And yeah, it was nothing but GameStop. I was like, what in the world is going on? Like, I was actually in the car driving up to Dallas, and my phone was just going off. And that's the day that it jumped up 50% in a day. What?
Mhm.
And then that's when I discovered Wall Street bets,
Mhm.
that whole Reddit thing. So there was very valid reasons for going in at, we were buying at, $12, $15, and our hope was to get up to $55. They just blew through that.
Right.
Aggressive growth got completely out at around $100 a share.
Mhm.
And then Alpha is technically still long it, but I've sold out of it like 20 different times. So everything that's in there is pure growth. At one point it was up like something stupid, like 2,000%, the
Wow.
Alpha one. I mean,
Mhm.
so aggressive.
Are you there? It seems like you froze. So while we wait for Sean's technology to catch up, because it looks like it did freeze.
Am I back?
Yeah, you're back. Okay.
Okay. Yeah, I'm obviously not home. Me and my wife are up in Breckenridge this week, so the internet was feeding fine, but maybe not. What did you hear me say last?
Oh, so what we were talking about is that we did have it in a couple of our portfolios. You pretty much sold out of all of it, and this is GameStop only. And you get a little bit left on our most aggressive portfolio, the Alpha, but it's mostly just what was growth out of what we
It's
purchased.
100% growth. Yeah, everything that's in there. If I'm comfortable with it, because it's just literally it's house money. Like
Right.
we made so much off of it in Alpha. I'm just gonna I think it's got 0.5% exposure to it right now.
Mhm.
I'm just gonna leave it in there. There are still some positive catalysts for it, and its price is so far. It's back down to out of Looney Tune price land. It's come back down to earth.
I remember
And
asking you about AMC while this GameStop was going on. I said, "Are we in AMC?" And you said no. Well, I guess we didn't have any data other than what was going on with the craziness of Wall Street bets. There was no data that made that unattractive.
That was 100% Wall Street bets thing. There was,
Okay.
not even on our radar. That was, Fugazi.
If there's any other questions, I just want to make sure to ask in the Q&A. We'd be happy to answer those. As we wait for some of that, there is one other question that I want to talk about here. Is a question from the audience. Are there additional diversification tactics that we should be engaging in? What about refinancing mortgages? Do you foresee interest rates plateauing?
Diversification that we're doing or that they can do on their own, I'll answer it separately. But
Okay.
if you're with us, we're not just, and this is super important. I've talked about this repeatedly, but everyone just forgets or assumes, everyone's invested just in stocks. There's stocks, there's bonds, there's currencies and commodities.
Mm-hmm.
Currencies and commodities get overlooked because people don't understand them and the research providers don't understand them either. We have an advantage. Our research provider is outstanding and they spend as much time on commodities and currencies as they do stocks and bonds. So you don't need to have all of your net worth in stocks. That's you're opening yourself up for heartbreak at some point in time. So if you're with us, that's what we're doing. We're playing in all four of those markets. If you want to do it yourself, that's what I would do, is look at all four of those, especially commodities right now with inflation ripping.
I'd have to say before you move on from there, if you're going to do it yourself, find you a research provider that helps you dissect all that information. We've got how many analysts? Is it 30?
Last I heard is around 40, 43, 44, mid 40s. Hedgehog keeps adding and creating new teams.
And these are analysts across the world that are providing data on a daily and weekly basis that we get the feeds from that data and we're able to crunch those numbers. So if you are doing this yourself, make sure that you're not investing off of news headlines. Make sure that you're investing off of actually good data that you pay for, because
if it's free,
these individuals, they're not wanting to sell articles or like that. This is individuals, they get paid for data. And so, you get to judge them on the data. So, let's just jump into the second part of that. I just wanted to round out that answer.
Yeah.
Refinancing.
It depends on your time duration. Yeah, rates have been creeping back up because a lot of rates, they'll be keying off the yield on the 10-year, and that's been creeping up. So in the short run, yeah, I wouldn't refi right now if you're just starting the process, because it's probable we have some clouds on the horizon this summer, and the 10-year yield should fall pretty quickly. So
Which means that
I would,
mortgages will go down, mortgage rates might
yeah,
go down in the
depending
summer.
on, so that's just depending on how short or longer time horizon is. And again, this is just probabilities. Anything over, a couple months, you're just, you know what's probable.
Mhm.
The data and the market still has to agree with it. But in the immediate short run, I would sit tight until this summer.
Makes sense. Very cool. Would you give us a quick update as our last question is how our portfolios are doing year to date, and maybe roll in 1 year? We've got 6 portfolios we mentioned.
Yeah,
You want to talk about the
rolling 1
goals
year
of
is
each
probably more. Yeah.
goals of the portfolio versus how they're performing?
So all of our models, again, all of our Hedgeye is our research provider, our main research provider. So we have a thesis and a view on how we think things are economically going to play out, not just domestically, but across the globe. So we have this view, and across the models, we're going to be demonstrating that or playing that game plan slightly different. So they all are of the opinion that we're in an environment of rising inflation and growth. So we're long Swiss francs, we're long commodities, we're long domestic tech, high beta, a lot of emerging markets, China, Thailand, Netherlands, things that do well with a down dollar. The US dollar has gotten pounded in the last few months. All that being said, so our most aggressive one, the alpha one that we talk about, the trailing year, it's up 30, not counting today. I think before I got here, all the models are up somewhere around 0.2 and 0.8, somewhere in there, alpha being the bigger one. So not counting what's going on today, alpha's up 38.8% from last year. And then year to date is where a lot of it is 23% year to date is alpha. But our moderate model last year, trailing 1 year, is up 8.6%. And then this year it's up 3.99.
Mhm.
So all of the models are hitting their goals on a trailing 1 year, which is the more important number. Year to date numbers this early in the year, they're interesting, but all the models are hitting their goals and on trailing 1 year and year to date for sure.
Right.
Aggressive growth and alpha have already hit their 2021 growth model goals. So I know I was joking the other day, I was going to go to cash, but like, it's crazy. I've never been up 23% on February 10th.
This
Wow.
gives an example of what markets in general are doing. Of course, we're managing risk on our portfolio, so we're trying to get the stated returns for each portfolio with the minimum risk to the portfolios. And so that there's a difference between throwing all the money in an S&P and just kind of riding the roller coaster, and then also trying to get returns that are stated. And it's very important for me to say stated, because we do state what we want each portfolio to return, because every client is different. Some clients just need income. Well, we want to get them that income with the minimum amount of risk. Some clients want to grow their portfolios as much as possible. And so we have the other side of the spectrum, and we still want to grow it as much as possible with the minimum amount of risk. And so that just kind of, an explanation of the portfolios. Okay.
All have their stated goals.
Exactly. Well, thank you everyone for attending. It is about 1 o'clock, so we'll wrap this up. Once again, this isn't investment advice. It's rather a conversation about how we do things and what we look at. This is an education in nature only. If you, however, would like to discuss how we do things and are interested in anything else, how we could help you directly with your portfolios, please let us know. If after this you want the recording to send someone you know, let us know, and we'll be happy to forward you the link once it's available. Again, we want to, from the Nest House to yours, we want to wish you a happy and warm rest of your day and rest of your week. Looks like it's going to be cold out there. Thank you very much. Have a wonderful day.
Real cold up here. See you guys.
Take care.